This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Project management. And first we'll deal with what's meant by the term project. It's a term which we will use automatically and usually correctly, but we need to just delve a little bit behind why we use that term in certain cases, because it's quite instructive. First of all, a project is something we recognize as not being part of our normal work. It is non-routine. It has a start and an end. You're assigned to a project maybe for 3 months. So it's not something that we're particularly used to dealing with. It is presumably quite novel, or very often novel, and will very often have unique challenges. So you might be asked to deal with the implementation of a new internet system, or the implementation of a new accounting system, something which you perhaps have never done before and will never do again. Usually projects have project teams, and project teams are required to bring knowledge and input from a wide selection of the stakeholders who are going to be affected. And these people coming from diverse backgrounds here may have very different priorities. So the people from the accounts department might want emphasis on good internal control. The people from the sales department want flexibility on selling prices. The people in manufacturing want to be able to make in big batches rather than go to just in time and so on. Potentially what they want out of the project is going to be quite different, and they begin to pull in different directions. And so they can get what they want, they may overstate their case somewhat. And the chances are that not everyone is going to get everything they want, so there can be competition for resources. There'll be different terminology. I, as an accountant, know what's meant by valuing inventory at a lower of cost and net realizable value, but I say that to somebody from IT, and maybe they don't properly understand how that calculation is being done. And different outlooks. Accountants are perhaps very cautious, want things to be tested very well, to be proceeding fairly gently, whereas maybe people in the sales department are much more anxious to get something out very quickly, and are not as anxious to make sure everything is tested well. And these different outlooks and different almost attitude to deadlines also creates friction. So our team may not work very well together. And then there's no benefit in most projects until it's finished. Either the whole IT project is implemented and works, or none of it is implemented and works. So you could be spending 1, 2, even 3 years developing a project and get nothing out of it at the end. And all of these characteristics of projects are really saying that projects can be fairly kind of high risk here. They are novel, something we maybe have little experience of. You have a team of people which is maybe slightly dysfunctional. We're not getting any benefit out to the end, and so on. And what we need to do is to watch what's called the scope particularly carefully. We'll see other things we have to keep an eye on, but I would put top of the list here scope. And scope could be defined as, what is the project going to achieve? What are we going to get out of it? What benefits are we going to get? And really this has to be pinned down at the start. Once people begin arguing for, I want this report, I want that report, and so on, the scope begins to grow and to drift. And that is usually a sign that the project is going to hit trouble. Why is project management necessary or useful or perhaps unavoidable in strategic planning? Well, you know that a strategic planning is typically a 5-year or at least a 5-year plan, potentially affecting the whole business. And of course, no one can do that as one kind of plan, if you like, and do it as one activity. What you have to do is to break down this large plan into little sections. So if you are thinking of opening abroad, first part of the plan will be maybe deciding which countries to go to. Having decided your country, then you go and maybe you find which towns you ought to be opening in, which city ought to be the headquarters. Then you have to go and perhaps find premises. Then you have to go and recruit people. Then you have to train them, and so on. So what we do is to get a whole project, to get a whole strategic plan accomplished, we break it down into little manageable chunks or parts. Each one of them is a project. And that becomes manageable because each one can be given a start date, a duration, and a finish date. With that, we can put in a cost, and we can assign a person to it, and we can have well-defined outcomes. And also, we can see what should be done first, the relationship with other projects. So before we begin recruiting people, we have to have an office to put them in. Before we can start putting machinery into factories, we have to have a factory built and so on. There's usually a kind of logical sequence to getting the parts of the plan ready. So it breaks it down: start, duration, end date. What this project comes after, what comes before, who's responsible, who's accountable for it, and what are the outcomes going to be from that. So we can say at the end of the project, we want you to have found 3 factory sites in Europe. And the factory sites have to be of a certain square meterage and so on. And that's what we're aiming for this project. Stages of a project. And there are all sorts of, if you go on the internet and Google, stages of a project, you get all sorts of responses, because project management is a very big business and many companies try to put their own spin to make their project management approach look unique. But by and large, we're going to go through these steps, whatever they're called. First of all, and this is often left out, but there's usually a project screening stage, which is where you look at a proposal and you immediately say, for some of these, we're just not going there. It is so obviously not sensible at this stage. We're not going to actually spend any more time or money or effort on it. Assuming we get through this stage, and as I say, quite often, that's a kind of preliminary to the actual project starting itself. This is getting through that first little test. Then these two are required very close. Sometimes risk assessment is part of a business case. I like to keep it separate. I think it's very important when looking at projects, especially if you're looking at the business change where it's going to be kind of big bang or whether it's fairly fundamental. We need to look at the risks. If this doesn't work, what's going to happen? Obviously, we'll have spent money and wasted money, but some projects, if they don't work, actually cause more damage than that. They irritate your suppliers, or they irritate your customers, or your customers don't like what you've done and they go elsewhere and so on. We have to assess in particular the downside risk. What could go wrong? Business case, we're going to be looking primarily, we'll see a slide on this in a moment, at cost versus benefits. How do we justify doing this project in terms of increasing profitability or increasing, say, our service to, for example, patients in a hospital? Then we need a plan, and a plan that can be very detailed. It will say, when are the various stages or activities in the project going to start? Who's going to be in charge of that stage of the project? Who's going to be keeping an eye on it? What's it going to cost? How long it's going to take? And so on. And note here, what we have really saying here, we have a strategy. And then to achieve that strategy, we may be breaking this down into various projects. And then what we're doing, we're breaking it down further, each project into little stages, usually called activities. So if this project was building the factory, then the activities for building the factory would be maybe finding a site, then digging the foundations, then putting up the bricks, and then putting on the roof, and then putting in the electrics, and installing the machinery, and so on. And the project plan is really down at this very detailed level here. It is almost a day-to-day, week-by-week plan of what has to be done. Then we carry it out with reference to the plan, of course. And as we're carrying out, we'll find sometimes things go astray. We have to monitor how we're getting on. We have to control the project. If something is falling behind time, then maybe we have to push more resources to it. If something is falling behind time, then there's going to be a knock-on effect in subsequent stages of the project, and maybe we have to readjust those timings. And there's things called project milestones. A milestone is really saying, right, in 4 months' time, these are the things we really want to have accomplished. We'll have a little pause there to see, are we on track for achieving the deadline for the whole project. And then finally, there's a bit of a looking back, a bit of a post-mortem. There's going to be closing the project, delivering it, and reviews of how we got on with the whole project process. A business case should be prepared for any project, and it's basically a cost-benefit analysis. It could be looking at, well, costs are obviously going to be in money, benefits could be in money, we could be looking at increases in profitability. Costs could be in money, but the benefits might be more intangible. The number of patients we can see, the number of pupils who maybe get a certain grade in an examination, and so on. Like any project, then, and you remember from F9 when we were looking at the net present values, of course, questions were often using the word project. A company is thinking of a project where they're going to put up a new factory, etc., etc. And really, by far, the best way of dealing with a business case is to do a net present value. This takes into account the time value of money. Of course, we're making estimates and that. We need to be aware of maybe sensitivities and how far we could go astray with that net present value and so on. Simpler methods, this payback and return on capital employed, can also be made to make the kind of profitability type business case. We look at sensitivity analysis, we look at risk analysis, we may be looking at forecasting techniques. It's all very well putting up this factory, but how many sales are we going to be generating in 5 years' time? And we may have to be looking at techniques like linear regression, we may be looking at scenario construction and so on, topics that we looked at in an earlier chapter. Also, of course, a project is looking into the future. We're not always certain about what's going to happen in the future, and expected values and decision trees may have a role to play as well. Weighting the outcomes with the probabilities to help us make decisions. Usually costs are easy to budget. They are money, nearly always, and they tend to be really soon. Most projects involve spending money now or nearly now in the hope of income for the future. Benefits are often much more difficult to put a figure on, very intangible, very difficult to quantify with any sort of precision. But of course, unless you make some attempt at doing that, it's going to be almost impossible to do your business case. You're going to have all the costs there, and you're going to have no benefits to kind of weigh the scales the other way. So we need to try to make the best effort we can at trying to put figures and indeed put money on these benefits. What we've got here, and it shouldn't be saying completion at the top, I don't think, in here, but if you look at the benefits here, they can be broken down into 4 classes of potential benefits here. There are observable benefits, and observable benefits were completely impossible to forecast, and indeed may have been completely unexpected. So we put in a new IT system, and as a kind of byproduct of that, after it's been in for a few months, we notice that our employees are happier. Happier because they can get the information they need more easily, happier because they can give customers a better service. Now, we may have tried to quantify the better service being given to customers, but we may not have even anticipated a happier, more motivated workforce. However, we observe it in retrospect, and it's good, but it's going to be of no use whatsoever in any sort of cost benefits analysis, because we can't quantify it, we might not even anticipate it. Measurable benefits are measurable in retrospect. So we put in a new IT system and we find that, let's say, average inventory is down, and maybe collection period down. Both are benefits. If you can survive with less inventory, if your customers pay you faster, that's good. However, we may have found it very difficult to anticipate in advance with any sort of accuracy what those effects are going to be. We can measure it, of course. Retrospectively, we can say average inventory has fallen from 5 million to 4 million. Average collection period has fallen from 49 days to 37 days, or something of that sort. But it's going to be often very difficult to predict what that's going to be. And if you can't really predict it, again, it's not much use for a cost-benefit analysis. What's meant by the word or term quantifiable here? It is quantifiable and it is predictable. So in other words, we are now willing or able to predict with a certain degree of, I suppose, confidence, how the collection period will actually decrease. And if we're going to be doing that, we need really kind of some evidence. And the sort of evidence that we might get to move us from measurable to quantifiable, because once we're on to quantifiable, we're on to figures, and once we're on to figures, we can be on to money pretty quickly. And once we're on to money, we can do the cost-benefit analysis there. But maybe it could be a reference site. So the person who's trying to sell you this new IT system says, come along with me, I'll take you to one of our previous happy clients, and they will tell you how much their debtors collection period has improved. And you go along there and they swear blind that their collection period dropped from 54 days down to 37 days or whatever it was. And at least there's some evidence there, although beware that the company selling the software will only ever take you to a very happy client. Maybe what you can do is a pilot operation. So maybe you've got several branches, maybe 20 branches. Let's say each for some reason keeps its own receivables ledger. What you do is you put the new system into one branch. You measure what happens there, and if they get an improvement on 20 days on collection period and a reduction of inventory of 25% in one branch, then there's evidence that that is going to be achievable in all the other branches as well. And maybe you see simply a competitor's performance. They use that system, they seem to be delivering to customers much more quickly than we are. Maybe the secret of them doing that is they have implemented an IT system. Maybe we should do the same. Once you have got to quantifiable, generally speaking, getting to financial, certainly in a profit-seeking organization, is relatively easy. Note, however, that this jump can still pose some difficulty. We might get onto quantifiable here, for example, let's say in a hospital, our patient days, being kept in after an operation or something, goes down from 7 days to 5 days. There's still maybe quite a leap there to saying, what the financial effect of that is. Or even more difficult, we're thinking of bringing in a new form of treatment to somebody. And let's say the new treatment raises life expectations from 6 months maybe to 10 months. Obviously, it's something that looks very worthwhile, but hospitals and health authorities are faced with really a very difficult challenge here. If they're spending millions upon millions upon millions of dollars putting through this improvement here, it has to be balanced in some way. We have to, in some way, try to work out what is it worth giving somebody 4 more months of life, given that the funds are likely to be scarce, and if we don't spend the money on this drug or this sort of treatment, then we could maybe be helping other people in other ways and so on. We still need some way of deciding how best to spend limited resources, and a business plan tends to be the way in which that is often done. We mentioned project risk, something that ought to be looked at, particularly in terms of the downside risk. And it's often said that the project risk depends on these 3 variables. First of all, how well defined is the project? Is the scope actually crystallized? Is it really well defined about precisely what we're going to be doing? Or is it a hazy type of idea, we're going to improve inventory management, without really saying how we're going to improve inventory management? The project could be small or large. Quite obviously, a large project, there's more that could go wrong, there are more things to manage, there's more money going to be at stake. And it could be relatively simple, or it could be very complex. Again, obviously the more complex, the more cutting edge a project is, the greater the risk. These 3 variables can all move kind of independently here, but if you're put in charge, or asked to be put in charge of a poorly defined project, which is very large and very complex, the chances are that's not going to be a success. Try to get out of that one. If, however, there's a project which is very well defined, everyone agrees on what we want to do, its ambitions are relatively modest, and it's not particularly complex, it's something that's well understood, there's every reason why that project should be a big success. I'm not saying that we should never do large projects, or that we should never undertake complex projects. This is quite often how you get your radical changes, or how you maybe respond to disruptive technologies there. But there should be really no excuse whatsoever for undertaking a project which has not been well explained at the start, or well defined at the start. And it's a project initiation document where much of this planning work is actually held and recorded. Think of it as a handbook of the project. It sets out what the project is going to be, why we're doing it, who's involved in it, how we're going to do it, by when it has to be accomplished, all the important questions. And very importantly, at the start, it defines the project scope and its deliverables. Remember I said you're going to have a number of people in the project team. They all want, what they want, basically. They're all competing over resources here. And poor project management means kind of fudging that issue at the start. Kind of saying to everybody you're going to get everything. Whereas what you should be doing is saying to people at the start, well, you're going to get that, that and that, but you're not going to get that part of the project that you would like. We simply can't afford it. Say to somebody else, you're going to get that and that, but you're not going to get that. This is how you define the scope of the project at the start. And it means taking hard decisions at the start. It means entering into a dialogue and maybe heated arguments with people at the start. But far better than trying to, ignore the inevitable that not everyone's going to be pleased. It's going to have the cost benefit, the business case there, the risk analysis. It's going to determine who's paying for it, which departments, whose budget is it going to be coming out of. It defines who's going to be involved in the management of the project, who's going to be in the management team, who's going to be what's known as a sponsor. We'll talk about some of these roles in a moment. It will have the detailed project plan within it that we talked about. It's going to give everyone the information they need to be productive and effective right from the start, to know when their assignments are starting, how long it should take, what it should cost, and so on, how it fits in with the rest of the project and so on. As I say, it's like a handbook of the project that should be there at the start for everyone to look at. If you need to change anything, strictly speaking, you need to go through another cost-benefit analysis. So if, for example, the scope suddenly comes out with a really good idea, it'd be very useful if we had a different report. It's going to cost money to generate that report, to change the software and so on. And rather than just saying, yes, you can have that report, we should go through and say, well, it's going to take 5 days of programming to produce that report. What's the sort of benefit we're going to be getting for that sort of expenditure? What's the risk in beginning to alter computer software once it's partially made? The people that we talked about, the sponsor. The sponsor of a project is really the person behind the project who really wants the project, who's almost the champion of the project. And very often the sponsor is the person who's going to be paying for the project, or the department will be paying for it. So it could be that the finance director is the sponsor of a project to update the way inventory is held, because the finance director sees there's a lot of wastage in current inventory practices. The manager of the project is the person who is given day-to-day management responsibility for making sure the project comes in on time, to date, hits the milestones, hits the targets, and so on. Quite a diplomatic person, having to deal with very different people. And then there's the project team, usually drawn from a number of different departments. They tend to be stakeholders, maybe, in what's going on, and they bring together complementary skills. So people from accounts know from the accounts perspective what they need in an inventory system. The people from manufacturing know the sort of responsiveness they need from an inventory system, and so on. We need somebody from IT to maybe actually deal with the technical aspects of that project. Project team, group of people with these complementary skills here. How many do you want? Well, think of meetings you've been to maybe with 20 people. They're not particularly productive usually. Everybody wants their say. A lot of idle chat almost goes on. Very, very difficult to control it. Yet you want enough people on it to have these complementary skills. And maybe something like about 6. Once you get, to much above 10, you're going to have quite an unwieldy sort of a team, and you need to think, what are the extra people actually, what skills are they bringing to this? Many people might want involvement because they feel they have a stake in the project, but we have to think carefully whether the involvement's actually needed. You have to try to unite them in what they want out of it. You have to try to pin them down to an agreed scope of the project. Right mix of skills, but also right mix of personalities here. So the personality of somebody coming from accounts could be very difficult from typically people from the sales department, which again could be different sort of attitudes and approaches and kind of methodical approaches to people from IT. And you're getting these very different personalities and having to try to get them to work as a team. And it's a project manager who's responsible for that. And it can be very skilled, very kind of diplomatic post to be filled. The variables in project management are said to be the following. First of all, the time. How long are we going to spend on the project? What's its deadline? There is the cost. How much money has been agreed with the sponsor? There is the scope. What is the project actually going to accomplish? And very often within this, quality is also a variable, if you like. We want to make sure that we keep the quality of the output high. What tends to happen is that one of these muscles its way to the front. So if, let's say, the tax authorities in the country say, from the 1st of January, you have to deal with income tax in a different way. And if you haven't done it by the 1st of January, you won't be able to pay anybody. Now there, what's going to happen is everyone will have their eyes on this kind of immovable deadline. We can't trade really unless we have the new IT system working. And what is a danger of happening here is to get to that deadline, you begin to throw money at it, and the cost goes haywire. Or maybe to get to the deadline, you don't test the new IT system properly, and the quality becomes poor. It's not a very reliable system. Or maybe what you begin to do is to cut out certain reports that people have said were quite important, but maybe they're not absolutely vital, and they get removed from the project. So because of the concentration on time, the other three variables are going to suffer. Alternatively, there might be an emphasis on cost, that the sponsor says we cannot spend any more than $500,000 on this project. I will not spend any more than $500,000 on this project. Then, to stay within the cost budget, of course, there's a risk that it takes too long. You don't pay people overtime. You won't bring in temporary staff, subcontracting staff to finish it. You begin cutting bits out of the project. You begin skimping on testing, because testing costs money and so on. And because we have an emphasis on the cost in here, the others are at risk. So what the project manager has to try to keep balancing is all four of these here, not to let one of them kind of take over and to elbow the other ones out here. You have to keep them going forward in a balanced way. Sometimes what inevitably happens is you get something which is called slippage. And slippage usually refers to time. That the project is not going to be finished on time. Because even with the best managed projects, the unexpected happens. And when slippage happens, or is foreseen to be going to happen, we have to have a way of managing it. And what the project manager has to do is not just to hide or conceal this danger, the project manager has to find a way of sorting it. And this will usually mean going to the sponsor, maybe going to members of the project team and discussing it. And basically the options are as follows. You can let it take more time. Maybe time isn't that desperate here. You know, we hope to finish it by the end of March, but actually it won't really matter too much if it doesn't happen to the end of May. It's not something which is absolutely time critical, and that's in a way an easy solution. Alternatively, slippage might be on a project where we simply cannot allow the project to be finished late. In which case you have to get the agreement of the project sponsor and other stakeholders. Are you going to spend more money on trying to get it speeded up, bring in subcontractors and so on? Are you going to cut something out of the project so we get the really vital bits done by the end of March, and then we can do the other less vital bits maybe by the end of May? You should never be really interested in cutting quality. The other thing, of course, that might happen is that the slippage is happening. We don't want the slippage to happen. We don't want to spend more money. And maybe what your sponsor says, okay, let's make it a simpler project. Let's do this year, see how it works, and then maybe we'll have another go at it in another year or so when we've learned a little bit more about it. But discussion with people, the options, is absolutely vital, so that people are kept in the loop and you're not surprising people with unwelcome knowledge. Finally, we have the completion of the project, and there is a completion report normally expected showing the outcome of the project. And this is used really retrospectively to show which bits of the original plan that was promised have actually been delivered, to see whether or not there are some outstanding issues that maybe have to be completed within the next few months and so on, to see if we stayed within the budget, to see if we stayed within the deadlines and the scope and so on. The completion report can itself comprise of two sorts of reviews. First of all, there's how did almost the technical management of the project progress. It's about the management of the project. So I think emphasis here on the project. How well did the project team work together? Did we hit our deadlines? Did we hit our budget? Was the technical management of the project and all the tools and so on that we used in managing the project, did they work well to accomplish the project pretty good? And then there is what's called the post-implementation review. And this is really almost going back to the cost-benefit analysis. We could have had a perfectly run project in terms of hitting the scope, hitting the deadline, hitting the budget. But actually, even though we did it kind of perfectly, it's all been a waste of money because the promised benefits haven't materialized from that. So if we'd had our time over again, we'd simply not want to do the project. So has the project delivered anything of sufficient value at the right cost? Were the projections and promises made with the best intentions on the cost-benefit analysis, were they realized? Because if the benefits are down here and the cost is up there, something's gone wrong. And we need to learn from that. We need to learn what happened in our business case, if you like, that promised so much benefit coming from the project which was not actually realized. We need to learn from both of these. If the project was a bit of a mess, how can we stop it? Or if it went well, how can we repeat that trick? And if the project turned out to be deeply disappointing, we don't want to be throwing kind of good money after bad in the future. We want to know, again, how we can prevent this miscalculation happening in the future.